It's a bold claim, but it's more realistic than you might think. Teaminvest is an exclusive investment community with over 600 members across Australia and New Zealand. We use our proprietary software and the wisdom of the crowd to analyse companies like business owners, not speculators, to identify wealth winners and avoid capital killers. Our members expect an annual return of a minimum of 15 to 20%, with many of them achieving much more over the 18 years we have been running. At Teaminvest, we are about transferring our knowledge to the next generation of investors. Whether you have been raised with an awareness of investing or whether the family legacy begins with you, our goal is to educate and equip you with the knowledge and tools to build generational wealth. I'm Kerry Fleming, and welcome to the Teaminvest Wealth Builder podcast. Today, I want to tackle a question that is at the heart of long-term investing. Can you really achieve 15 to 20% returns on your original share investment just by focusing on dividends? It's a bold claim, but if you understand the principles and commit to a disciplined approach, it's more realistic than you might think. In today's episode, we'll explore the power of dividends, the importance of patience and quality, and I'll walk you through some real-world examples, including how these lessons apply in today's market. So let's start with the basics. When you buy shares, you can look at your portfolio in two ways. The current market value, what you'd get if you sold everything today, or the income that it produces year after year, your dividends. Legendary investors like Warren Buffett focus on the income stream, not the daily price. They know that over time, a growing stream of dividends can deliver far more wealth and peace of mind than chasing short-term gains. For many investors, especially those planning for retirement or seeking financial independence, the question is, if I hold and buy great businesses, can my dividend income eventually match or even exceed my original investment each year? The answer to this comes down to two words: compounding and patience. When you reinvest your dividends, either by buying more shares or letting them compound within a fund, you set off a powerful chain reaction. Each year, your income grows, not just from the companies increasing their payouts, but also from you owning more shares. Over 10 years, this can turn a modest yield into a substantial income stream. The key is to focus on quality businesses with a track record of growing dividends and let time do the heavy lifting. So let's bring this principle to life with a scenario close to investors in 2025. Suppose you started building a portfolio of high-quality, dividend-paying ASX shares in early 2015. You focused on blue-chip companies with a history of growing dividends. Think the big four banks, Wesfarmers, Woolworths, CSL, and a couple of major resources like BHP and Woodside. Let's say you invested $100,000 each in 10 companies for a total of $1 million. At the time, the average dividend yield on your portfolio was about 5%. So in your first year, you received roughly $50,000 in dividends. Now fast forward to 2025. Over this decade, several things have happened. Some companies have cut dividends temporarily during the pandemic, with most recovering by 2022. Many of these businesses increased their dividends steadily, especially as Australia's economy rebounded post-pandemic and commodity prices remained strong. You reinvested your dividends each year, buying more shares, especially during 2020 and 2022 in the market dips. Today, your original $1 million portfolio is likely worth around $1.7 to $2 million, depending on your stock selection and reinvestment discipline. More importantly, your annual dividend income is now in the range of $90,000 to $110,000, nearly double your starting yield, and that's before franking credits, which you can add another 1 to 1.5% to your effective return. If you calculate your yield on your original investment, you're now earning between 9 and 11% per year in cash income. And if you include the franking benefits, you're well into double digits. In a couple more years, especially if dividend growth continues, you could see your income approach 15% of your original investment, even if the share price never moves. And this isn't just a theoretical scenario. If you speak to long-term investors, you'll see exactly this pattern. Patience, disciplined reinvestment, and a focus on quality has turned moderate starting yields into powerful income streams. So what does this mean for investors starting or building their portfolios in 2025? First, the ASX 200's average dividend yield is sitting around 4.2% this year, with many blue chip companies offering yields between 5 and 7%. And that's before you factor in the franking credits, which remain a valuable tax benefit for Australian investors. Interest rates are higher than what they were a few years ago, with the RBA cash rate above 4%. This means term deposit and bonds are more attractive during the ultra-low rate era, but they still lag behind inflation and don't offer the growth potential of equities. What really changed was the market's attitude to dividend sustainability. After the shocks of 2020 and 2022, investors are laser focused on the companies with reliable growing payouts. Companies that cut dividends during tough periods were punished, while those that maintained or resumed growth have been rewarded with strong share price recoveries and, in some cases, record highs. Let's consider a real-world example. If you bought shares in National Australia Bank during the market pullback of 2022, you could have locked in a yield above 6%. Since then, NAB dividend has increased twice, and the share price has recovered more than 25%. Your yield on cost is now over 7%. With even modest annual dividend growth, you could see that climb to 10% or more within a few years. The same pattern holds for investors who bought into Woodside Energy or Wesfarmers during market dips. The combination of rising payouts and reinvested dividends means your income is compounding at a rate that outpaces inflation and rivals the best fixed income products on the market. Now, are we saying that you should invest in these companies? No, we're not. This is simply some examples of what we've seen over the last few years. The key lesson is market volatility is not your enemy, it's your opportunity. When high-quality companies go on sale, you can lock in elevated yields that set you up for years of rising income. And over a decade, with patience and discipline, you really can achieve annual returns of 10, 15, or even 20% on your original investment just from dividends. Now, of course, not all companies are created equal. The secret is to focus on businesses with 1, strong balance sheets and low debt, 2, a history of steady or rising dividends, 3, industry with durable demand and pricing power, and 4, management team that prioritize shareholder returns. It's also vital, as we say, to ignore the noise. The media loves hype, daily price swings. But as a dividend-focused investor, your real question is my income stream growing faster than inflation? The answer is yes, you're on the path to real wealth. So as always, here's a few practical steps that you can take to achieve those 15 to 20% returns on your original investment. 1, track your yield cost. Don't just look at today's yield. Calculate your dividends as a percentage of your original purchase price. Secondly, reinvest your dividends where possible. Compounding accelerates your income growth. Thirdly, review your portfolio regularly. Focus on companies that consistently grow their payouts and are willing to replace laggards. Fourthly, take advantage of market dips. When quality companies go on sale, adding to your position can turbocharge your future incomes. And fifth, and probably most important, be patient. Magic happens over 5, 10, or even 20 years, not overnight. So, Can dividends alone safely ensure 15 to 20% returns on your original investment? The answer is yes. If you focus on quality, reinvest your income, and let time and compounding do the work. Remember, measure your success by the income your portfolio generates, not by its headline value. Use market volatility to your advantage and stay disciplined and patient, and you'll be amazed at how your income and your wealth can grow. We hope you found today's discussion insightful and inspiring. If you know anyone else who could benefit from hearing this episode, please hit the share button and pass it on. If you'd like to learn more about Teaminvest or our unique investment approach, visit us at teaminvest.com.au. And please don't forget to subscribe to the podcast for more episodes. Until next time, stay informed, stay invested, and keep building wealth.